Hey everyone, and welcome to Boss Advisory. Today we're going to talk about assets and liabilities. Assets put money in your pocket, whereas liabilities don't. Liabilities cost money. Obviously, you want as many assets and as few liabilities as feasible. In this video, I'll explain assets versus liabilities. Then I'll tell you how to increase your assets and reduce liabilities. The difference. Assets and liabilities are different. Financial accounting defines an asset as anything useful. Value frequently means money. Still, many get confused. Here are classic examples. Is a house an asset? Unless you plan to sell, owning a home is a major liability. The mortgage and monthly maintenance bills will drain your finances for years. Not exactly putting money in your pocket. If you aim to sell the property for a profit, you might call it an asset or an investment. Why? Investing is anything that can generate a measurable return. Stocks and bonds are assets because they create income through dividends and capital gains when resold. Is a car an asset? Buying a car lowers the price. Used automobiles depreciate quickly compared to new ones, so they're not assets. Since the car can be resold, many argue that it's an asset. Good assets produce profit. A depreciating car isn't an asset. Whether you sell it 2 hours or 2 years after buying it, since you won't sell it for a higher price. However, historic or collectible cars can gain value, not rare cases. Most folks acquire a daily driver for personal use. Difference between tangibles and intangibles assets. Very simple. Tangible assets are real. They're touchable. Land, property, equipment, cash, inventory, etc. Intangible assets are not physical, not touchable. Financial assets include brands, patents, copyrights, etc. Financial versus real assets. They're often mixed up. Real financial and tangible assets are mostly grouped together, as though they're the same and generate the same profit, yet they're not. Real assets have intrinsic worth. Intrinsic value is a financial asset's genuine value without market impact, which is why they are called real assets. Financial assets use the market trading price to define their value, which means you could end up paying more than something is worth, which is bad because you'll lose money. This is why people like Warren Buffett talk a lot about finding a company's intrinsic value, so that if a stock costs more than its real value, if the market price is lower than the intrinsic value, you will likely make a profit in the future. When market price exceeds intrinsic worth, financial assets derive their value from contractual claims. I'll discuss stocks and bonds considered as tangible assets. Amongst them, financial assets are easier to convert into cash. Assets like real estate and commodities are harder to cash in on. The mother of all assets, stocks. If you don't know how stocks works, let me explain them to you. Stocks are most well-known assets with huge potential for investors. What are they? Stocks are a company's shares. You buy a small percentage of a corporation when you buy a stock. Imagine having a house and you can come and buy one brick. You own the brick, so you're part of the household. But why would anyone want to buy a brick? First, you need to understand that when you buy a stock, you become a corporate associate. If you hold enough shares, you can vote on corporate decisions. 2 ways to make money with stocks. Stocks can be profitable in 2 ways. First, capital gain. This implies buying a stock and selling it when its price rises. Buy a stock for $5 and sell it for $7. You'd make $2 and be set. Price increases? No, they vary. All graphs show this. Demand and supply affect market prices. Demand increases a stock's price. If you think a stock will grow in demand, acquire it since you can sell it for a higher price. If you're wrong and the price goes down, you'll lose money. If you know what you're doing and evaluate the companies you buy, you should make money most of the time. Second way to make money through stocks is with dividends, which are issued yearly, quarterly, or semi-annually. Dividends are like owning a company's bricks. If you buy one brick, you'll get 1% of the house profits. How to buy stocks. Opening an online stock broker account is easiest. Your bank offers these services too. You can invest directly with your bank with fees charged, so every transaction gets taxed. It's harder to buy from the corporation directly. It's time-consuming and more expensive. Assets include real estate. Property is an asset in certain circumstances because, as I indicated earlier, having a home to live in forever without the aim to sell, it's an expense. Yet some investors buy underpriced property to resell. Then it's valuable. This is easy in theory but difficult in practice. As a realtor, do this. You start your day with discounts. You search for bargains. Underpriced means it suggests you want something with potential but poor management. Because it has flaws to address, it's cheap. Fixing faults will increase the property's value. Modernizing, repainting, or adding furnishings can all raise a property's price. Factors that influence the price of a property include timing, location, community, economic indicators, and interest rates. Or you might rent the property after repairs. This will add monthly income. Residential, industrial, raw land, and commercial or special use properties exist. You might not have the money, confidence, or knowledge to buy, rent, or sell property, and you might not know where to start. So you can't buy these assets. First, you could learn. You can also buy REITs, or real estate investment trusts. With REITs, all the knowledge is unnecessary. A corporation would invest your money in real estate and pay you a dividend. Many argue those are fantastic assets because they generate high dividend yields and long-term appreciation. When prices go up and you defy inflation with knowledge, which is an intangible asset, right? It's a simple asset. Imagine you operate a marketing firm. Simple enough. You help companies locate customers online. You can do everything by yourself. From marketing tactics to approach to copy, you need to delegate first. So you engage an accountant and a financial counselor. Hire content creators. They help produce marketing content. Then hire good salespeople to get more clients. They must convert leads. The better salespeople mean more clients and more money. Following me? Hiring talented people who can sell is an asset. You'll use it to make more money. Although ROI is quantified, you can quickly calculate monthly spending and sales commissions. Their knowledge is worth what they earn. Who is this for? Your employer probably isn't hiring. The thing is, you're an asset. If you master a vital talent that entrepreneurs need to expand, you'll be paid more for it. Thank you guys so much for watching Boss Advisory, and if you haven't yet, be sure to subscribe, give this video a big thumbs up, and hit the bell so you get notified on every new incredible content we make for you. Have a wonderful day and see you in the next one.